Hey, Mike here, and we're talking about syndications today. So you're probably asking yourself, what is a real estate syndication? And that's what we're going to cover here today. So essentially, a syndication is a way for you to pool your resources together and invest in something that you probably wouldn't be able to do on your own. So, if I wanted to, I could invest in a single family property, do it myself, make all the decisions myself, put up all the capital myself, and we'd be good. So if I wanted to do something larger, let's say an apartment complex or multiple apartment complexes together, we can do this through a syndication where we pool all of our resources together to be able to do so. So there's a legal path that we can do this because of the way the Securities and Exchange Commission has put this together through what's called Regulation D. So in a syndication, there's typically two types of parties. You have a GP or a general partner, and you have an LP or a limited partner. The general partner is going to be the person that's doing all the boots on the ground, all the decision making, and have a say in what happens with the deal. So they're probably the person that either themselves or through their team found the deal, put together the strategy for the deal, made the projections of, fixing up this, raising rents on this, doing this type of work. Here's our strategy to be able to exit the property or cash flow the property. They're also working with the property managers to make sure that they're executing on that, vendors, and then just making sure that they're following the guidelines of the creation here, the syndication, to make sure that everything's above board. So that person is very active in the role of what's happening, so they are the general partner. Then you have an LP, the limited partner. That person's typically putting up the money. So they're being able to invest in something larger versus doing it on their own. And so there's multiple people together that are probably wearing that limited partner hat, putting up the capital for the property. In that case, because they are a limited partner, they don't have decision-making authority. They essentially are putting their trust in the person that is managing the syndication to get the returns that they want, execute the strategy that they talked about before investing. So because the limited partners are essentially buying a security, this property or group of properties from the general partner, it is governed by the SEC, the Securities and Exchange Commission, through Regulation D. And so there's two types of syndications that you can do. There's a 506C and a 506B. So the differentiator here is you have to be an accredited investor for one of these. So what is an accredited investor? An accredited investor is someone that either makes $200,000 per year or has a net worth of $1 million. So you only have to have one of those three criteria to be considered an accredited investor. If you're not, that's okay. You can still do syndications. There's just a different type of syndication that you can do. So in a 506C, those folks are all accredited investors. So they all meet those criteria that we talked about. To be able to do that, to have a 506C, with all accredited investors, you can then publicly market the offering that you're looking to do. So you might see ads or promotion of, hey, I have this deal that I'm doing. Here's the deal. Here's the projected numbers. If you're an accredited investor, reach out. So that's what you can do under 506C. If you're under 506B, you can work with non-accredited investors. And so in this case, you can take up to 35 non-accredited investors. You also can have accredited investors as a part of this offering, but it's not something that you can market publicly. So this is something where, if you're working with friends or family, they want to see that you have a pre-existing substantive relationship with the person. And so it's not just, hey, I've never met you before, come invest in this thing. It's we're friends, we're family, we know each other. And so an attorney can advise you on kind of what constitutes a substantive relationship. But typically it's, you've known them for a month or two, you've met together with them, you've worked through strategy. How much money do I have? How much money am I willing to invest? And you understand what you're getting into, because you want to make sure that you're showing that the investor knows what they're investing in and you're not trying to pull the wool over their eyes or do something like that. So you can't market that property because you're working through the relationships that you already have, the people you already have been in relationship to do that. So that is a 506B. So the legal document that guides this is called a PPM, a private placement memorandum. And so once you get everything together. You decide who's going to be investors. You put together this private placement memorandum, and then you have a SEC attorney to be able to advise you, put everything together. That's usually a costly affair. Once again, this is why we're probably doing larger deals, to be able to account for those legal fees to put together this syndication. And so the PPM is what guides this property, and the general partners are typically, like I had mentioned before, saying here's the property, here's the types of returns, here's what we're looking to do with the property. But this isn't for somebody who hasn't done anything before in investing. You want to be smart, you want to be sophisticated to be able to take on something of this risk. After that, there's different ways that you can split the profits on this, whether it's cash flow, whether it's the equity stake at the end. There's lots of different ways to structure the deal. So the general partner that's typically putting together the strategy, putting together projected returns, will analyze, what percentage of this syndication is going to have limited partners and what percent is going to have general partners. And then how are you going to break out that cash flow? How are you going to break out that equity upon the sale or upon a refinance, something like that, to be able to make the numbers work. If the general partners are doing their job, they're putting something together with enough meat on the bone so that the limited partners make money. Because this is a relationship business, you want to make sure that the limited partners are happy, that they're making money, because once you sell that property, you want to roll that in probably into a larger property or a different property. And so you want to make sure that you're taking care of the people that are putting up the money to have a good story to tell, to go have more investment. So that is an overview of a real estate syndication. I should just quick add the disclaimer: this isn't legal advice, this isn't investment advice. Consult your own attorneys to be able to make a decision for yourself on this. But this is just an overview of what is a syndication, and possibly this might be something that would be a fit for you. So if you want to learn more about syndications, if you have questions about syndications, general questions, just feel free to reach out to me. Happy to help point you in the right direction.